not a never ending flow, but there's a lot of investors out there and a lot of banks. So we continue to build our pipeline of banks that are available. And the presentation today is an overview, but keep in mind that a lot of the scenarios are going to be case by case. So this will give you an idea of what we offer. One of our main banks, this is built off one of our main banks. But if you have scenarios that don't fit the criteria, then we'll look for other investors, and I'll look at other programs as well to compare and make sure you get the best deal we can give you. Kate, anything you want to say?
I had to figure out how to unmute myself. Yeah, only that Shane is like the master strategist at mortgages. So, you know, if in the future, don't be afraid to come ask questions. If you have other information from other lenders, or even like, I know a lot of the rain ladies are looking at private money or hard money and trying to compare like what would be the best scenario for me. You know, these are great questions for Shane. He's great at looking at your scenario and like figuring out what would work. So don't be afraid to ask, and don't be afraid to come to us with that, because we really enjoy helping you. We like to see you succeed. So this is great for us. So that's it.
All right, we'll get started here. All right, Kate, can you see the screen? I think that is a yes. All right, so this is our overview. We're, financing for your real estate business, investment business. All right, topics today. We're going to go over some fix and flip information, the DSCR, which is debt service coverage ratio, and explain how that works. Most of you probably know, but we get questions on how exactly the math works on that. Construction loans and short-term rentals. So the fix and flip is available to individuals and to businesses. Multiple projects can be funded under the program, and we have more than one investor, more than one bank available. So if one bank limits you to a certain amount, we can also, if you use that up, we can set you up with another investor to use a similar program. There's minor differences between the investors, but most of them facilitate pretty similar transactions. The interest is paid on the drawn balance. It's up to an 18-month loan term. There's no prior experience required, and the funding is up to 100% of rehab costs on a case-by-case scenario, 95% of loan to cost, and 75% of after renovated value. So these scenarios are definitely case by case. It matters how much experience you have. Different lenders will provide different ratios depending on experience level, asset level. One of the big factors that comes up, the main factor for fix and flip, is your experience. So the property loans, about the minimum we can do is $75,000, and the maximum, it depends on the bank. Some are set to 2 or 3 million. Some are set higher. So we say that's to be determined based on your specific scenario and your type of property and your experience levels and whatnot. 12 to 18-month loan terms. We actually do have some banks that go past that. 24 months is the longest that I've seen so far. But the fix and flip is pretty much designed to get that property fixed up and moved out from under the lender pretty quickly. So, those terms are typically a little, they're on the shorter end. Minimum FICO for the bank that we're presenting here today is a 620. I have seen lower than that, but most people are going to be at 620 or above anyway, so that's probably a non-issue in general. Extensive rehab financing available. You're not really limited as to what you can rehab on the property. Very extensive rehabs if you want to add, put an addition on, or, a gut and rehab, all of those options are available. So the DSCR loans, we do these on purchase. purchase and hold or on refinances. So the question that we've run into quite a bit is how you calculate a DSCR. And it's really a pretty simple calculation. You take the operating income from the property, which is your gross rent, and you divide it by the cost of the property, principal, interest, taxes, insurance, and homeowners association dues, if that's applicable. You'll come up with your ratio. We have banks that'll, some want you to be no lower than a 1.0 ratio, which is if your rent and your costs were a ratio of 1-to-1, if they were the same. We do have banks that'll let you go below that. The lowest I've seen, I believe, is 0.65. This will dictate your terms. This is a very significant part of what your interest rate will be, your loan to value will be. So, you know, that loan to value dictates your loan amount in reference to what your appraised value is. So that's an important aspect. You want to, when you're looking at these properties to buy, you're already looking at what you can cash flow, I'm sure, but that also has a significant impact on what type of, how large your down payment's going to be or how much equity you need. So all of the DSCR loans have to be non-owner occupied. Some of our banks require that you own a home currently. I did run into one I was talking to yesterday, and they will actually lend to you if you rent, but you would have to show proof of a lease. But I don't think that's a very common thing. So non-owner occupied, because these loans do not fall under TRID or RESPA. And if a person were to purchase a home and live in it under one of these programs, the trouble the bank could get in is pretty significant, and they will accelerate, they call it, which is foreclose, if they find out that someone has used this for an owner occupied purpose. So it's pretty important that we make sure these are only investment properties that the purchasing entity or person is not going to live in. The same loan amount here, 75 is typically the minimum. Usually you're above that. Maximum just depends on the investor. We have different amounts with different investors. First-time investors are allowed. Again, must not be a first-time homeowner, though. You actually have to own a home at the time that you use this product. The max loan to value as a guide here, again, this isn't written in stone. For a purchase, 80% loan to value. Cash out refi typically is around 75%, but we can get above that with certain investors. And the vacant property, that's another factor that comes in. If you don't have the property leased at the time that you refinance, you can see a reduction in your loan to value. Again, loan to value is the comparison of the loan amount versus the appraised value. So you can see a reduction in your loan to value and an increase in the required amount of reserves that you have to hold. So reserves are referenced as assets that you hold that we don't do anything with. We don't put a lien against them. We don't encumber them in any way. You just show us that you have those assets. So 1 month of reserves is 1 month of your principal, interest, taxes, insurance, and HOA dues added together. That total monthly cost. Most of the time, a lot of these banks are looking for 6 to 9 months in reserves. If the property is vacant, the bank we're discussing here typically wants to see 9 months in reserve. If it's not vacant, between 3 and 6 months a lot of times. So on the debt service coverage ratio loans, we offer a 30-year fixed, which I think is a good idea right now since we're in a rising rate environment. With inflationary pressures that we're looking at, we haven't seen these types of inflation numbers in, they're saying 40 years. We'll probably see some rate increases in the future. So it's important to strategize there with what you plan to do with the property. If you're looking to hold the property as a long-term asset towards maybe retirement or something like that, 30-year fix is probably a pretty good idea. So you don't see that payment increasing over time after your fixed period is over on an adjustable rate. But we do offer ARMs. We do offer interest-only options. Again, strategy comes into play. It's just, what your intent with the property is. If it's going to be something you hold for a couple of years, a 5/1 ARM probably makes sense. But if it's something you hold, past the 5-year mark or intend to, a 30-year fixed is I think probably going to make a lot of sense. Seasoning requirement, as of right now, to get cash out, I'm looking for more aggressive investors all the time, but as of right now, the best we have is 90 days of seasoning in order to use the appraised value to get cash out on the property. So I know that's something that comes up a lot with the groups that Kate's been working with, is the ability to pull money out that you've invested in the property. That most banks that we're running into are 6 months. Now, you can get cash out based on the purchase price with these other banks, and you don't have to have a seasoning period on that. But a lot of times people are buying the home and then putting money into it, and then they want to cash out to reinvest. And that currently we're looking at 90 days on that seasoning requirement. The DSCR with this specific lender, their minimum middle FICO is 640. And that can be based off of the highest score. Like if there's more than one person on the loan, and on the residential side, we're used to going with the lowest middle score. We always have to tell people that. The commercial side, a lot of times we can actually use the higher score of the two borrowers. So that's something to keep in mind if you have someone that needs to be a guarantor and their credit isn't quite as good as yours. The banks like to see these properties leased within 180 days of closing. The look back from a bank, it just depends on the investor, and that's something we have to discuss on a specific investor, kind of scenario. We offer construction loans, and the construction loans can be done on single family residence and multi-units. I know that on the multi-unit side for the DSCR, we can go up to 20 units currently. I'd have to double check that on the construction. I believe we can go that far or up to that size as well, but I'd have to verify that. So the minimum requirements to qualify, you have to have one new construction property built, or one fix and flip, or one fix and hold in the last 36 months. Now, this can also change based on the investor. The bank that we're working with here on this presentation is a little bit more aggressive than some of the other investors. I have an investor that requires that you have 5 new construction builds or fix and flips in the last 3 years, but they do have a little bit more aggressive terms. So you'll find that the banks with the more strict requirements tend to have a little bit more aggressive terms as far as how much they'll lend you compared to the value of the property, and what the interest rate and costs will be. So for this product, for the construction, the minimum FICO is 620. Exposure limit is set at 500,000 to 10 million. That does not mean the minimum loan amount is 500,000. That's the minimum exposure limit that they set. The exposure limit is set based on the borrower or the entity and the guarantors. So you could have a house that you're building for 220,000. They'll set your exposure limit to 500,000, which means that you can't exceed that. You can actually have multiple projects going at once, up to your exposure limit. Loan terms, 12-month interest only, fixed rate, and 18-month options on these. And again, it comes down to the different investors. Most of the time typically they're only charging you interest on what you've drawn out. You're not going to pay interest on money that you're not using. The investors have different ways of calculating what they're going to lend to you. One of the investors we have will take I believe it's 7 times the liquid assets you show, and that's what they'll set your limit at. This bank has a little bit more of it's not as simple as to determine their exposure limit. So again, the investor that we choose may work better for certain investors than others, certain borrowers than others, I should say. All right, short-term rentals. This one's pretty simple here. The terms are very similar to the long-term rental. And this is, excuse me, this is based on specific scenarios. So to calculate, I think a lot of investors don't actually do the short-term rentals. Probably about half of them we've looked at don't like to do those. And it's mainly because it's a little bit more difficult to calculate the rental income and the debt service coverage ratio. So you're still using a debt service coverage ratio on this product, but typically you're going to, the banks themselves will set different look backs for rental history, but you typically would provide your rental ledger. Some banks may want to look at a tax return to see what you reported in income on that property for the last couple of years. Most of the time, though, it's simply showing some pretty basic documentation to the appraiser and to the investor or the bank. So the rent ledger, or your like a 12-month list of what you, if you're using Airbnb, you know, a history on that specific property is helpful. And a lot of, you know, they're also pretty, they're a little bit more careful on these types of loans, because if they think that you're trying to do an Airbnb in an area that won't cover, or that won't really sustain that, the bank may decide they don't want to lend on that property. So the banks do have the ability to do a case-by-case, kind of like a common sense underwrite, to make sure that they feel that the scenario is secure for them. On a purchase, you technically, you know, the bank's not necessarily going to come back and look back too much, excuse me, on what you're doing. So if you did qualify based off of the debt service coverage ratio of the that's listed based on the projected income on the appraisal, or if you have the property leased out, then it's easy enough to purchase. You can convert later to a short-term rental if you chose to. The short-term rental, as far as qualification, this is typically going to pertain to refinances, in my opinion. Simply because you haven't made a decision a lot of times when you buy the house exactly how you're going to rent it out. And that's, you know, depends on how we present it to the bank and the investor. This is our contact information, which Kate will share with you later. She can send an email out with the info. But if you need to track us down, this is how you get us. So I'm going to stop the screen share here and start the discussion. Anybody have any questions on any of the info we went over, or specific scenarios you may be looking at?
Yeah. It's Kimberly. Can I ask a couple real basics here?
Yeah.
So maybe I missed it. So Shane, you're working as a broker. Are you just working as a mortgage broker? So that's what you call yourself, a mortgage broker? Okay, great. And then when I look at these 4 scenarios, as Kate said, you know, based on whatever the scenario is for us, you could help guide us into terms of what would be the best solution. I get that. And you made a comment, which I thought was great, because you said that, yeah, you know, the DSCR, and I'm like, I don't even know what the heck that means. So I figured out that debt service credit ratio is what that means as you were talking. But I've never heard of that before. And I've bought 4 or 5 homes and sold them just because of where I've lived in my life. And I guess that wouldn't have counted. There wasn't an actual vehicle when I was purchasing and living in the homes, it sounds like.
No, so the reason that if you live in a house, then you have TRID and RESPA. RESPA is Real Estate Settlement Protection Act. I forget what TRID stands for right off the top of my head. Mm-hmm. So TRID and RESPA regulate lenders, brokers, anybody that's involved, real estate agents, anybody involved in real estate. And these regulations govern properties that you would live in or second homes. Okay. In general, there's still, you know, if you're buying a 1 to 4 unit as an investment property through Fannie Mae or something like that, there are still some potential guidelines you could run into that you have to adhere to. But these products, when the re-regulation occurred, products were around like this back during the subprime days. And they were also offered on primary residences. So you could do a no income, no asset, or stated income, stated asset, where you didn't verify income. So what happened was the the CFPB, Consumer Financial Protection Bureau, came out with a set of regulations. Most states actually set their own regulations as well. And then afterwards, the states typically just adopted the federal regulations. But a lot of those regulations revolved around setting limits on APR, setting limits on points that you could charge. So there's a limit to closing costs there. And these all pertain to primary residences, set requirements for disclosure, set timeframes for disclosures. So it's a very different regulatory, aspect, I guess is how I'd say it, regulatory environment in relation to a house that you don't live in or a house that you do live in. So if you were buying houses and selling them, the DSCR, debt service coverage ratio, is not something that really would have been discussed. And these loans are a little bit newer, probably in the last 2 years I've seen them. And one reason that they have not existed for a while is because the lending business overall was running scared from TRID and from the CFPB. They've issued a lot of fines. There was a lot of kind of open area where they did not define their regulations very well, and banks would be fined over that. So there's been a lot of clarification since TRID has been put in place, and the investors and the banks at this point feel pretty comfortable from a legal standpoint to offer these types of loans now. So that's why you haven't. They are a little bit newer.
And so that's helpful because they're distinct, obviously. And I guess when I hear you also talk about that your ratio plays into the interest percent that you get, you had a list of items on there. Can you talk a little bit about your credentials and your experience? Because I've heard that from a friend that's gotten a hard money lender loan, and they were talking to her about her background and resume. What are you seeing in terms of what's considered experience? I saw a couple things on there, like one flip and fix, one flip or one buy and hold, 36 months. But what's considered experience to the average lender, a hard money lender in this case?
So I'll make a distinction. Most of these banks that we're dealing with aren't hard money lenders.
Okay.
Hard money is, I've dabbled a little bit in hard money in the past, and it depends on who the investor is, who the hard money source is. But it's a less stable option, in my opinion, most of the time, and a little bit riskier for you as the borrower. And the reason being is there's very little regulation on these products because they're not covered by TRID and RESPA. So most of the banks that I have been setting up with for investors, the first one we set up with is a bank that I've worked with on the residential side for about 8 years. So I know they're solid. I know they have a lot of assets behind them, and I'm not concerned that they will ask you to pay them a fee and then run away. But back to your question a little bit more is, so I would separate hard money. Hard money is hard money. What we're offering is more of a bank option, but it's not like a local bank. It's an investment bank.
It's not a community bank. It's commercial.
It's a community bank. It's a commercial bank, and most of these banks that we're dealing with are also involved in residential lending. So the scope of what they do is significant, and they've added these products to diversify their portfolio and to, be profitable in certain times. Right now, we're looking at a huge lack of inventory on residential. So a lot of these banks have been entering the DSCR and fix and flip and whatnot arena so that they can continue to profit with the money that they want to lend. So these banks have money to lend, and if inventory dries up and they're only lending 60-70% of the money they have available to lend, that's money that's sitting there they're not earning interest on.
Can I ask a question? Because we're going to go, there's one more question. How can it be drying up when it's a seller's market and it's booming right now in terms of the market sales? And we're in short housing and everybody's moving.
Because the volume of homes available to purchase has decreased.
Really?
That's almost throughout the country. I've done local research, looking at, talking to real estate agents, finding out what the amount of homes listed in the counties are compared to what's typically available. Last year, we were at 1/3 to 1/2 of the inventory that's typically there. This year, we're, I think, coming up a little bit from that, but we're well under what we typically saw available in the past. So what's happening is it's a strong seller's market. We're seeing, I live in State College, Pennsylvania. That's where Penn State is. And we're seeing between 5 and 10 offers per property. I have a client approved at 560,000 is his max. He's finding homes listed at 500 to 510, and he's offered 550 to 560 on 3 properties in the last 4 weeks, and he hasn't gotten any of them.
Oh, yes. Okay. Got it.
So that's the market's hot, and it's
Yeah.
a definite seller's market, but the volume's down, which means we're doing less loans.
Got it. So going back to, I'm sorry, this is helpful, but the credentials. So with this scenario with commercial loans in these scenarios, what would you consider is experience versus not experience, just from their perspective?
So this is going to come down to the investor. So I had an investor I was talking to the other day, bank investor. I'm kind of using the term loosely here. They basically, they wanted a definite fix and flip or to see ground up construction to finance. They were more interested in financing builders. And it depends on the focus of the lender. So the credentials and the experience is going to be identified by the specific investor or bank. So it depends on what their focus is. A bank that is focused a little bit more on fix and flip. The bank we're presenting here, the bank that, like I said, I've worked with for about 8 years. They actually, I was really grilling. I have a client right now I'm working on pre-approving, getting him ready. He has 4 lots that he owns and he wants to build on. He has not done any fix and flips that were titled in his name recently. He did one, but it was titled in his brother's name, and he got a 1099 because they had an operating agreement. But since he wasn't on the deed, the bank I'm looking at won't accept that as experience.
Didn't show it. Yep. Gotcha.
He's in the process of fixing to hold. He's fixing a property up right now that he intends to get a lease on and then sell it. But since he hasn't sold it yet, that's not considered experience. He does hold, though, 2 properties. One that he renovated. Actually, he's in the process of renovating 2 properties currently, but he has 1 property that he bought and he turned it from a 4-unit into a 10-unit. And it's it's like he has it zoned as a hotel. It's a halfway house, basically. So I started researching and figuring out, all right, what can I offer this guy? And we should be able to get it through by showing that he fixed this property up and held it. But you run into odd little scenarios, like if it's not a property that the bank would lend on, they may not allow you to count it as experience. So it's important to research the options properly so that, and that's my part of it, that's my job. But it's interesting to me anyways, how the credentials change per investor. So in general, what I just described is what the banks are looking for, but it certainly comes down to the investor. So some investors will say you have to build a house ground up or we won't finance anything for you if you're trying to do a construction. Some will say a fix and flip, and we'll count that. So the fix and hold, that was, I had to dig a little bit to find that, but I was, because they don't always publish all of their requirements. So sometimes you can find an option just by having the conversation, an exploratory conversation with the rep from the bank and digging in a little bit further. So very bank to bank, very scenario driven. And, if I can't find it with one, I'm looking at the rest of my investors to see if I have an option.
Right. Thank you.
Mm-hmm.
I have a couple questions.
Okay.
So along those same lines, if I'm a part owner in a construction company and we've built houses from the ground up, but in my investment company is it's a different entity, can that still count as experience?
It should, as long as we can show that we'd have to show the paperwork and show that you personally are the owner of the construction company.
Yes.
That should qualify as experience.
Okay.
Now, when you built the homes, did you build them with your own resources and then sell them? Or is it?
No, typically the homeowner owned the land and then they did a construction loan and paid us draw.
So
That's different.
that is different. And that would be one of the case by case things where I would present that. But if have you done any fix and flips in the other business? Or fix and flip?
Yes, but a million years ago.
Well, if it makes sense, this is more of I'm used to doing FHA and VA and Fannie Mae, and it's cut and dry. They don't care if it makes sense or not. If
Right.
you don't fit the guidelines, you don't fit.
Right.
These scenarios can be manipulated a little bit based on common sense.
Okay.
So, that's something I would, have a conversation with you or any other partners that are involved with your businesses, do a conference call, figure out, how I can best present your scenario. And then I start taking a look at my different banks and investors and see who's going to potentially take a look at that and ask for an exception to get us through. If you've had fix and flips in the past and you've built homes and you own a contracting company and you also own a real estate investing company, there's a good chance I could find something that would work for you.
Okay, great. How do the interest rates compare to HML rates?
I'm
Like,
sorry.
are they- How do the interest rates with some of these options that you're offering, like the DSCR loan, how do they compare to HML rates?
What do you mean by HML? You mean like a residential?
Hard money lender,
Oh, hard money lender. Okay.
sorry.
In general, I would say they're better. I have not gone after hard money investors, so I haven't researched their interest rates recently. I've seen too many. I dealt years ago before actually it was right after the meltdown there in 2008. I moved away from hard money because I had a bad experience with a lender that I was trying to set up financing for a client I had here in Pennsylvania. Basically, the economy wasn't doing so well, and the investor pulled their money, and they had already taken some money from my client, and it's not as, I'm not gonna say it's not as regulated, but when you're dealing with banks, you have a much higher probability that they're not going to go away and they're not going to do something that is unscrupulous, because they can be sued.
Mhm.
Regulatory action can be taken against them. Even though these scenarios aren't regulated the same, you still can't come in and take somebody's money and still continue to do business. The attorney general of the state that you're in will go after them. The CFPB would consider going after them. There's a number of regulatory agencies that would go after them. So what I'm seeing, though, as far as interest rates go, if you're asking me what I'm seeing out there, I'm typically seeing 6.5% to 8.5% on the DSCR.
Okay,
That comes down to your credit score, comes
Yeah.
down to your loan amount, comes down to your DSCR level. So if your DSCR is 1.25, that means you're cash flowing at 25% on the property. They're
Mhm.
going to give you a better rate than if your DSCR is 1.0.
Right,
1.0 is no cash flow.
okay,
So again, the rates are very scenario specific. The fix and flips and the construction are higher rates, but those are a much higher risk to the investor or bank, because they have to trust that you know what you're doing with that money.
right.
And that's why they want the experience.
Mhm.
And the rates may be worse. All right, so for your scenario, maybe we have to negotiate to get something lined up. So your rate on your first few transactions may be worse.
Right,
But then we would reassess, possibly use a different investor and get your rate, get you the best deal we can get you, basically.
yeah, okay, thank you.
Mhm.
Very helpful.
Anybody else? You guys are like me, you don't like using the chat function in the,
Oh, sorry.
no, I prefer to talk than use the chat anyway. Is Kimberly talking but muted there?
Yes. I'm not short on questions or shy on sharing, so my mother and my sister will speak on, can speak on that. I do want to ask a quick question about timing. I mean, one of the things that, you know, in this women's network that we've been in is the people that we talk to preach over and over again about real estate investor friendly settlement offices, banks, real estate agents, and so on because of timing. What are you noticing in terms of timing for getting proof of funds? Like, you know, we're talking about trying to make deals. We have sometimes 2 days, 3 days, and then settlements, and how they're, you know, they're timing for application and approvals.
So it depends on what you're setting up. If you're trying to do a long-term purchase, if you give me the terms from the property, I can issue a pre-approval pretty quickly. We would have your credit on file, or, I mean, depends on the bank. Some of them don't want me pulling your credit. They want to pull the credit themselves.
Right.
So a lot of this is based off of you giving me accurate information. And I tell people, I know you're not going to lie to me, because if you do, you're hurting yourself. You're not hurting me.
Right.
You know, you
Right.
can't lie to the mortgage guy. He sees everything. I see this more on the residential side, but so as long as you're giving me information up front, this is why strategy calls are really important. So before you decide you're going out there to do whatever you're going to do, if you want to work with me and Kate, should say Kate and I, if you want to work with us, we should have a conversation before you go out and start finding properties. We should talk about the parameters you're going to deal with. We should talk about your objectives. We should talk about, you know, whether or not you're going to cash flow on a specific property, or, you know, I can give you, based on the area you're going to, the strategy call can really kind of help to set the tone for what you're going to do, and it will also help speed things up. So I can give you a pre-approval based on certain parameters. And once we have that, or once you have the property under contract, then we need to line the financing up. So the financing typically moves pretty quickly. I would say, I mean, the absolute minimum, I think, would probably, because again, you're dealing with a bank, you need an appraisal. You have to have a title search ordered. Probably 20 days would be about the minimum, I believe. And depending on how quickly things come back, it can take longer than that. So.
Yeah. Okay. Yeah, those are longer than some of these shorter deals that, you know, we've been paying attention to where some of the wholesalers are working with distressed properties, and some of them are settling, you know, I mean, we all were looking at these a couple of days ago that, you know, we look at these and they say offer today, decision in 2 days, and then they're settling in 6 days. So that's where hard money lenders can jump in, because they can be quick. They also have non-qualifying loans. So our personal assets and our FICO scores do not have anything to do with it, from what we've been told. I haven't worked with any of them yet, but this is the experience that folks are sharing. So to your point, it's riskier, but it's also about the comps of the property, not my personal accounts on my personal credit and so on. So I guess those are the kind of risks, right? Timing is a risk in this case.
Timing can be a risk. I think that, I can't say this for sure, but I would guess that you're also dealing with more of a case-by-case scenario where somebody may pledge some money to you and then say, no, we're not doing it. This is what we're offering is a more structured, more secure, and typically financially more aggressive towards, or more beneficial to you. Less closing costs, lower interest rate. But in that scenario, the bank does want to make sure that they're not walking into a loss.
Right.
So we do have, there are some automated valuation methods that can be done that can speed up the process. A lot of this comes down to where you are in the country. So if you're in a pretty populated area, things typically will go faster. But I would never say that I could give you money in 2 or 3 days or 6 days. I wouldn't see that being a real viable option.
Yep.
If you're doing fix and flips, it's a little bit different. You've got your, once your exposure limit is set, those can move more quickly. because you've kind of already established your scenario there. I think the biggest timing issue is the appraisal. That's the main thing.
I keep forgetting about that because we don't talk about any of that in the specialized knowledge that we're getting. We just, everybody goes right to, you know, the non-qualifying loan scenarios because of timing, and appraisals are not one of the criteria.
Mhm.
Okay.
So some of this stuff, you know, like the fix and flip depends on what's out there for hard money. The new construction, I think we're probably, I would guess we're quite a bit more competitive than a hard money scenario. I would say the rent and hold.
Mhm.
If you use hard money, if you're going to hold that property, you probably want to get better terms on it if it's going to be a long-term note. And the hard money people probably aren't looking to hold long-term notes anyways.
Right.
So they're probably going to want you to cycle through that in 8 to 12 months.
Yep. Yep.
So Shane, to qualify, I mean, it's just like another mortgage. You got to give them all your taxes and all that kind of stuff.
It depends on what you're trying to do. Most of the debt service coverage ratio is based on the property. But most of the time you do have to have an appraisal. Now you can do an automated valuation method, which does speed things up. So it's your credit score, your experience level, and then the home itself.
Okay. And so we're typically buying these properties in our company name,
Yes.
not our, okay.
Yeah, Sherry, you won't need, unless there's extenuating circumstances like Shane mentioned with business tax returns, you won't need any income verifying, like no W-2s, no personal tax returns, and no, you know, income documentation.
You do have to provide assets though. That's you have to verify where your money is coming from to complete the transaction.
Is that just a proof of funds? Like, you know, you can, I just did a private money lending for one of the Ren peers, and all that the organization, the first lien holder wanted was proof that the money was there, so I would be backing out and costing the deal. So I just literally sent statements of 2 months worth of statements to show that there was money in the account. And so that was it. They didn't want to see anything else. The settlement office could care less. And this was in Florida. So everything was felt like very right off the cuff and very informal and casual. It was kind of interesting, quite honestly. It was very low key.
Yeah, we'd be looking for one
And
bank statements depending on the investor.
Gotcha. And then I asked a question, Kate, I sent you that question.
Yeah, I have it here.
yeah.
You want me to ask it for you?
Yeah, because I can't remember what I said.
Okay.
Because I'm thinking about my mother and my sister and I, or if
Right.
Sherry and I did a deal, like if I did a deal with, you know, different people, that was where that was coming from.
Right. So she asked Shane, how do we structure and work financing with a hard money lender? Or do you mean just any lender?
And well, in this case, I didn't know if you guys were working with who you're
Okay.
working with. So in
Right,
this
so-
case, commercial banks that you all
Right.
work with.
So how do we structure and work financing if a joint venture has 2 or more parties providing money and equity stakes?
So most of the time, if you're going to be a guarantor, the bank pulls your credit. I think if you're not a guarantor, they don't have to pull your credit. It's going to come down to the investor though, as far as whether or not they'll allow you to qualify out just one person in the joint venture, or if it's going to have to be qualified if everybody has to have their credit pulled. So it'll be that would be a little bit more of a case-by-case scenario. Again, the banks that provide the better terms typically want a little more information. So there's a good chance, you know, they want to make sure that somebody didn't just come out of a foreclosure or a bankruptcy.
Right.
You know, things like that it's risk assessment. All lending is risk assessment. And the a lot of times the hard money lenders, their money, sometimes the money's from out of the country. Sometimes the money is, well, the one I was, the bad experience I had was, I believe United Arab Emirates or Saudi Arabia was the backer. I forget which one. Not the country itself, but somebody that had a lot of money over there.
Yes.
So, the risk assessment from a bank is going to be different than maybe somebody that just has money that they're not doing anything with it and they want to see if they can make some profit with it. But banks have shareholders to answer to and regulators to deal with, and so sometimes they're going to require a little bit more. So again, case by case, it's going to depend on the bank that we use or the investor that we use. How many? There's you and your mom and sister, so there's 3 of you. Okay.
Yeah.
I'll check on that with a couple of the banks that we're working with.
And you don't have the LLC with all 3 of you on it, right?
No,
Right,
and
okay.
that's, we weren't sure what everybody was actually doing at the time. And really, were we all going to really be working this? I mean, this was like, I did this very early on when my sister and my mother were just doing things at a different pace. That's all. And so I didn't want to include that and then not knowing how that would impact. So
Yeah.
the question is what's the smartest way for us to organize ourselves, which I know is not your guys' expertise. That
Well, you should be able to, if you're a sole member LLC,
yeah,
you can have outside operating agreements or agreements with investors
right.
that don't necessarily have to be shared with us. If it's in an operating agreement, we would probably see that. If you have an operating agreement, the bank does want to look at it. But you can have other investors involved. Just have a contract drawn up that doesn't really change any of the legal structure of your company, and you could be the only guarantor. That may not be ideal if there's other people making profit and you're the only one guaranteed. So
Yeah, and that's part of why I was asking about that, because if all 3 of us had an LLC and we did a joint venture amongst the 3 LLCs, then we would, if we all wanted to have, a stake in the game, right? So financially, that means either we're putting money in or we're putting time, right? But that joint venture would still want all of us to have be on the guarantor as well as a title, so that we're all in it together, so to speak, whatever the percentages are. But that's why I wondered how the commercial banks that you're working with actually see that. And to your point, are they running everybody's credit? Is one person the primary? Does it even matter? I mean, so just trying to understand what we have to think through. And that's more of a strategy conversation, I think, as you've said.
Well, I think also if you're doing a joint venture, it's usually under one LLC. You'd have an operating agreement to tie you together. I don't know how the bank would view multiple LLCs. Typically, there's going to be one entity that is the guarantor of the mortgage.
Okay.
I'd have to see if you can do multiple LLCs, but usually when you're doing a joint venture, it's one LLC with an operating agreement that brings in the partners. I'm not sure how, and it may depend on the state, how you structure things like that. I'm not exactly sure how you do it with multiple LLCs though.
Yeah, what makes it more complicated is we're all 3 in different states. So there you go. And then there's that, right? So,
Right.
okay.
This also may be a good, this may be a good question for your title attorney or your title company, because they kind of, they have to make sure all those legal things are in a row to fund the deal correctly. So,
A lot of times that's a different attorney than a real estate attorney. Sometimes they overlap, but if you have an attorney that's created your LLC, that's definitely, I mean, I can tell you what the bank's going to want, but it's definitely a good idea to have that conversation with an attorney that structures entities.
Yeah. Yeah. I've got one of those, that Anderson Advisors is the person that I'm working with. And I haven't brought that back to them as of yet, but I'm really more, like you said, I'm more concerned with what does the bank need, or
I'll find out. I'll follow up and find out for you.
that'd be great.
then the other question we had, Shane, was where can we lend and where can't we lend? So currently, we cannot lend in, as far as us personally, principal home mortgage, we cannot lend in North Dakota, South Dakota, or Vermont. That's completely off the books for us. And then the other 3 states we're not currently not able to lend in personally is Kansas, Iowa, and New York. So we would have to be specifically licensed in those 3 states, and we are not. So those 3 are off the table for us. So
This also comes down to the investor or bank. Not all these investors and banks are licensed in all the states.
right.
So the main bank we deal with covers most of the country. That's the one Kate was just discussing. But some of the banks that we're dealing with will be, some banks I can only go where I'm licensed, which is Pennsylvania. Most of the banks we're setting up with will let us lend in multiple states. So it'll depend on the scenario, but it's all related to where the property is, not where you live. Anything else coming to mind that you might want to go over? I think Sherry's talking to us. You want
I'm sorry. I said, I'm good. I'm leaving for the beach, so I'm gonna jump off and pack and all that kind of stuff. So thank you very much.
You're
And I'm sure I'll be in touch soon.
Sounds good.
All right, take care.
You too.
All right, if there's no other questions, we'll go ahead and end. Feel free. One thing I did not do is I did not require registration. So I have probably a lot of your emails, but I'm not sure if I have all of your emails. Shane did share that slide in the beginning. I'm gonna just, I should have done this in the chat earlier. I'm gonna type in my email address if you guys want to grab it and save it. Feel free to reach out to us. I'm probably in a lot of groups with most of you. So, you can find me there, friend request me, message me on Facebook. That's another, and it's just my name, Kate Whitaker. I don't have a weird name on Facebook or anything. So, feel free to reach out to us if you have any other questions.
Great. Thank you so much. I appreciate your time.
Yeah, we appreciate you coming on.
Thank you.
Have a good night.
Yeah, you too. Bye.
Thanks.
Bye. Thank you.
Oh, I better stop the recording.